Good day. Ira Epstein of Linn Associates with your agriculture update for this soggy Thursday, the 16th of May, 2019 at 3:50 p.m. Central Daylight Time. So weather markets are interesting phenomena. We keep raining and rain and rain. Now, as fast as it's raining, these things dry out. I don't know when that's going to happen. I can't tell you if suddenly over the weekend the forecasts were for much drier conditions throughout the upper plains, the Midwest, and so on. The game would change, but it hasn't yet. So these rains keep coming in. We keep looking out the windows. The traders do in Chicago. They see all that rain coming down. And while we don't grow any corn in Chicago, they extrapolate. And that's basically what's been going on as we're lifting a lot of these markets. Always remember what wheat is. Wheat is the volatile commodity of the grain market. It moves like that on you. It's like the old pork belly markets used to be, where they make dramatic moves for whatever reason. As we take a look at a weekly area chart of closes, we're finally getting a bounce. If we go back to the market, last week we finished at 797. We're up 42 3/4 cents from that. That's a nice rally that we're getting. I still say resistance is waiting for the market should you get up to that 18-week moving average of closes. When you come to the daily charts, remember we filled in this gap, and the market has stalled out basically since it's done that. You actually have a pattern of a lower low and a higher high, which is indicative of no trend at work. And where's the market fighting its battle? Often you'll hear me say, when a market starts rallying up, one of the numbers it might want to go to, like it did back here, is that 18-day average of closes to figure out what it's trying to do next. You got there yesterday, you filled a gap in the chart that was left here, and you're sort of stalling right now. Now, should you clear 848 1/4, what would happen is you might extend this a little bit because you'd have a pattern of higher lows, higher highs. What I don't like is seeing that extension come on already a 50, 60-cent rally. I'm not keen on that. When I take a look at moving averages, the only one that's in play right now is the 18. The Bollinger Band was in play. This big break is giving you the correction. Some traders will take Fibonacci numbers and take down to this low point to see how much this bounce might be worth. When I look at momentum, you're no longer in the oversold condition. So I have a neutral market that's gone back to the 18-day average of closes. I don't see any big purchases on the horizon to kick the market up. The market's getting a lift because the grain markets as a whole are getting a lift. When we go to the soy meal market, you have a vertical price rise. You realize you've gone now from this 283 level right on up to 304.90. That's a heck of a rally. That's $2,000 in real money that all occurred in a 48-hour period, and now you're sort of stalling. Should you continue to rally, I'd look for these two numbers, wherever the Bollinger Band and the 100-day average come in, to be your resistance numbers. The question is, will it find any support at the 18-day average of closes? As for a trend, there is none. In the soybean oil market, when we lost the embedded reading, the goal was, could you get to the 18-day average of closes, because it's the closest moving average. Excuse me. It did so. It extended it today, but not by very much. To me, it's again a market with the lower low, higher high, no trend. In the corn market, take a look at this. Tell me, if you go to the 18-day average, if you go to the upper Bollinger Band, what's the next resistance? Traders are going to look at the 100-day moving average of closes. That's what you're zooming in on. Now, you've gone here too, from 343 straight up to today's high of 380. That's a huge rally. It's over 10%. Markets that go 10% in one direction often, in short order, give you a stall. I'm looking for that to happen right in this general area between the upper Bollinger Band and the 100-day average. Are we trending? No. You've got a lower low, higher high. If you cracked down, maybe the 18-day average support, and you are overbought as can be. You're overbought in Chicago wheat. Now, here's the more interesting thing to me. You didn't spend an awful lot of time going sideways. You've still got that pattern. Now you're trying to push it out. And today's an outside day up. When you take out the low of an outside day up, the objective that I came up with, doesn't mean that it's real, is for price in the 18-day average to try to come back. If you stay over the upper Bollinger Band, I look for where's the next resistance if there's a key moving average above it, and in this case it's the 100-day at 484, about 17 cents higher. Overbought in an uptrend, but over the upper Bollinger Band. You only stay over that 5% of the time. If it's going to go, that could be the target. Take out this low of today, and I think you're back at that 18-day average fishing for direction. In the sugar market tried to lose its embedded reading. It got up yesterday like this, playing with the momentum. Now the momentum's turning down. If you take out this 1206 area and lose the embedded reading, I think people will say, we got cheap enough to have a bottom. If this market takes out 1166 going into a Friday, why not just continue down and head towards that lower Bollinger Band? Let's assume something else. You take out 1206, you don't go much lower, you don't take out this number, and you close over 1215. Who's to say you can't be in an uptrend? So all kinds of stories developing there. In the coffee market, this is the first bullish action in a very long time. Now, the bulls, not me, but the bulls were disappointed when we got up and over the 18-day average here, but it wasn't this pattern. The pattern is one of higher lows and higher highs, bullish. The market's over the 18-day average of closes, bullish. Momentum is pointing up, bullish. That's different than the market looked here, and it's certainly different than the market looked right here. Now, what would be the negative? Taking out today's low. Where is the upside target if it can follow through, which it's disappointed so many people on? Up here. But if I were a short tonight, I wouldn't like what I'm seeing right here. That's what I'm saying. And I wouldn't be surprised if the shorts are saying, maybe we've milked this enough. In the cocoa market, we look back at this number right here. We saw this pattern. We came down to the lower Bollinger Band, came back up, started fighting at the 100-day and the 18-day average, which we'd been doing for a while anyways. Today is the attempt to discard that and move to the upside. Problem is you're not in a trend. You have a lower low, higher high. If it can follow through, well then why not go to the upper Bollinger Band? If it falls back, maybe it has to play between that 18 and 100-day average to figure out what to do. But it's more of a market that went down, washed itself out, and came right back at traders. In the cotton market, as long as the embedded reading stays in place, this market looks good. But I am concerned if you get over 67.27. Should you get over that number and the big word is and with all capital letters, you lose this embedded reading at the same time, this market could decide to play a little catch up with what the other grains are doing as they're lifting up on the weather. Problem is I'm seeing it from the fundamentals, and charts are charts, fundamentals are different, is that this moisture is going to make the crop. That's what I keep hearing. In any case, as a technician, I don't want to see that taken out, but I don't care if it's taken out if the embedded reading just stays as it is with both numbers under 20. Could be a false breakout, and then the momentum takes over. This is the indicator that I think you hone in on. In the cattle market, you've got a pattern of a lower low, a higher high. Now, if you lose the embedded reading, and this one, as you can see, it's starting to arc up, then I'm going to look for price and the 18-day average to make a run at each other. If you were to take out 106.22, yesterday's low, I look for resumption of the downtrend. It would probably put that stochastic arcing back down. In the feeder cattle, this is just a bounce, but an important one to a degree. It's an outside day up. So when you get an outside day up, what should not happen? The way I teach charting is within the next 2 days, if you take out today's low, the odds favor you're going to go down to the closest of a key moving average. They're above the market, so the Bollinger Band comes into play. If the market wants to follow through here, fine. But in order to really have any real follow through, you've got to get rid of that embedded stochastic reading. And if you lose it, then the 18-day average comes into play. How often do I talk to you about that 18-day average being key to what markets do? You were in a downtrend, you hit the Bollinger Band back here and here, market started going sideways, you're embedded, you lose the embedded reading. When you lose an embedded reading, or an attempt at it, markets often try to get to that key average, and that's what you're doing right now. Are you bullish here? It's pretty hard to be bullish. 92.40 is where you're closing, and 92.90, let's call it 9300, it's the 18-day average. The bias is down, momentum is up, and the key to me is today's low. Why? Again, an outside day up. Don't take that out, close over the 18-day average, and you might get a surprise to the upside in the market. Wherever that Bollinger Band comes in over the next few days could prove to be a resistance number. Today, I'll tell you what I was looking at during the day. The pivot point. Why? I was watching the stock market rally, to be honest, and I'm looking at the NASDAQ, and I'm going, it's up 106 points. I wanted to know where the sell one, sell twos were coming in. Right there. And the market did back off, as you can see. Well, you'll run it tonight on your own. But if you'd like to learn about this, it's pretty simple. What a pivot point does is it takes the previous day's open, high, low, close. It's a formula where you add them up, you're dividing, and then you're adding to the pivot number to get sells 1, sells 2, buys 1, or another way is support 1, support 2. It's how you want to call it. And the idea here is you're trying to get it, if you're looking to be short, these are numbers you might look at. If you're looking to buy long, right here. The pivot itself is the neutral zone. What I did different is I tied momentum with it. And when I tied the momentum with it, I used the slow stochastic study. And what I look for is the stochastic embedded, getting overbought, getting oversold, embedding bearish. From there, I tie the charts together. And it starts offering, especially in markets that haven't had a lot of follow-through, like this week, it offers you some trade ideas. Keep in the back of your mind, we started off the week down in a lot of the stock markets, sharply lower. In the Dow, for example, down 600. You've almost made that up now. Does that mean you've gone anywhere? Not just yet. How do you get these? It's really simple. It's a 3-part series. It's free. You can go to our website, sign up for Pivot Points. You can go to give us a call. We'll take care of it that way. We'll get it right out to you. Or you can click up here. If you're watching me on YouTube, it'll take you to our sign up page. Sign up for what you want. We'll put it in your hands. I'm Ira Epstein. Have a good day.